Hello everyone, introduce us from Group 1. On this occasion, we will explain linking corporate and financial strategies. Next slide. This is our first member there. Aura Nadifa Nurkharisma, Faticha Putri Harda, Nooriza Shavina Az-Zahra, and Vanissa Tri Cantika. Next slide. Here are the learning objectives that we will discuss. The first, distinguish business risk and financial risk, and explain why there should be an inverse relationship between them. 2. Explain the different elements of financial strategy. 3. Assess how risky and particular business is, with a view to understanding how it should be financed. 4. Understand the 7 drivers of value and how they can be related to business strategy in order to increase value. 5. Discuss how the elements of financial strategy may apply differently to public and privately owned companies. On this slide, I will explain the difference between business risk and financial risk. Business risk is the inherent risk associated with the underlying nature of the particular business and the specific competitive strategy that is being implemented. It neither a high nor a low business risk is better, as long as the relative level of return matches the level associated risk either is acceptable. Next, financial risk relates to the level of debt a company is carrying, or its gearing or leverage. In assessing the riskiness of debt and equity, it's essential to specify the perspective from which the analysis is being made. Financial risk relates to companies' ability to generate sufficient cash flow to be able to make interest payments of financing or meet other debt-related obligations. Financial risk and business risk are two different types of warnings that investors should consider making an investment. So that an alternative way of looking at the difference is to view financial risk as the risk that a company may default on these debt payments and business risk as the company cannot function as a profitable enterprise. On this slide, I will explain the balancing business and financial risk with metrics. The combination of strategies in Quadrant 2 is not logical long-term basis for creating a successful business. Quadrant 1, this means that high business risk companies should use low-risk financing, that is, equity venture capital, and should keep their cost basis as variable and discretionary as possible. Quadrant 3 can result in a disastrous combination of a low business risk strategy and then even lower financial risk. The most common direction of strategic movement would be from quadrants 1 to 4, that is, moving from high to low business risk and from low to high financial risk. It is possible and logical for companies to move in the opposite direction. For the next slide, will be explained by my friend Shavina.
Okay, now we will talk about 4 elements of financial strategy. The first one is acquiring capital to implement strategies or sources of funds. 2 basic sources of capital beside net profit are debt and equity. Choosing the right mix of both is important to have successful strategy implementation. The second one is projected financial statements or budgets. Projected financial statements are useful to forecast the impact of various revenue and cost provision on the future cash flow, while projected financial budget shows how funds will be obtained and spent for a specific period of time, so strategy implementation can be done successfully. The third is management or usage of funds. Management of funds is important part of financial strategies. It is used to make decisions related to capital expenditures, dividend policy, investment, cost control, and tax planning. The fourth is evaluating the worth of a business. It's important because company may have another firm under diversification or divest under retrain strategy, and it's also necessary to establish the financial worth or cash value of a business to successfully implement strategies. Here we have three strategic analyses. The first one is Porter's five forces. Michael Porter sets five forces that drive the industrial competition, which are relative bargaining power of a buyer, relative bargaining power of a supplier, threat of new entrants, threat of substitute products, and degree of rivalry among industries. These forces are useful to analyze business risks and suggest where industries might wish to compete. The second one is pastel analysis. It considers how factors are likely to affect the company and the industry in which it operates. The factors are political, economic, social, technological, legal, and environmental issues or stand for pastel. The third is research-based theory. The research-based view of competitive advantage lies in the company's own unique set of assets, or what is the company good at. Any assets that an organization has must have the following characteristic: valuable, rare, imperfectly imitable, and non-substitutable. That's all from me, and the next slide will be explained by my friend Aura.
Well, now we will discuss about understanding how risky particular business should be financed. As we know, the business should make the best use of its available cash. There is a business case study. It is business with operation of using computer to access customer database, but the computer has not been updated in some time. There is some risk this business. The impact of getting hacked is losing sensitive customer data. The current situation is sitting on the scale as a likelihood high in level 3 and impact very high in level 4. Okay, here the level of risk is likelihood times impact, where 3 times 4 is equal to 12 severe. This presents as a severe risk. In the case study above, the level of risk can be reduced by updating software, changing passwords, and reminding staff to be very careful with business information and decline requests to provide information over the phone. While these actions might not remove the risk, they can reduce a highly likely, very high impact situation to medium likelihood, moderate impact situation. Often, high risk situations can be reduced to medium or low risk with some careful planning and action. Okay, now we will discuss about decisions in financial strategy. There is how large should the asset base be, how much of the finance should be debt, how much should be paid in dividends, and should we issue new shares? Okay everyone, let us remind ourselves of the key characteristics of debt and equity from the point of view of the company being funded. Debt is high risk and involves cash outflows in interest and repayments. Equity is low risk with no contractual cash outflow, although the board may choose to declare a dividend. Thus, a company in the high-risk launch and growth stages, needing to invest in assets and development, would be foolish to let cash leak out of the business to service debt. Even if a lender could be found with such a poor appreciation of risk that they would fund it. In maturity, with lower business risks and less need for cash for investment, it is altogether appropriate to make use of debt as a low-cost source of funding.
Okay, now we will talk about 7 drivers of value related to business strategy. The organizational aim is to create shareholder value. This is done by selecting a business strategy that it is believed will be successful. And that business strategy is derived from analysis of external force and of the company's internal resource and capabilities. However, the strategy so determined should link to what is seen to drive value in the business, using the 7 drivers of value. The 7 value drivers discussed by Alfred Rappaport are increased sales growth, increased operating profit margin, reduced cash tax rate, reduce incremental investment in capital expenditure, reduce investment in working capital, increase time period of competitive advantage, and last, reduce cost of capital. Next, developing strategies to enhance shareholder value. This figure shows that the strategy developed by internal and external analysis should also reflect the relative worth of the 7 value drivers. If this is done, and if the appropriate performance measures designed with targets that are stretching but achievable, value should be created. The drivers are not all to be treated equally in different business. Different drivers will be more important. For example, in a hotel with a high fixed cost base, the most important drivers is sales, as measured by the occupancy rate. Increasing the sale of room nights by 10% is likely to have far more of an impact on value than increasing margins by 10%. And the strategic focus should be on increasing the number of bed nights sold. This is a totally different model from, say, a bank lending to corporate customers, where profits arise from a slim margin between the rate at which the bank borrows and that at which it lends. Here, more value will be created by improving interest margins and by reducing operating costs than can be derived from increasing the volume of business. In such a bank, the cost-income ratio is an important measure of performance. The 7th value driver is the cost of capital. Managing financial strategy well can enhance the value of company. But financial strategy on its own is not a key driver of value for most business. Here, more value will be created by improving interest margins and by reducing.
Okay, now we will talk about how the elements of financial strategy might apply differently for public and private companies. In a listed or public company, although the shareholders own the company, the directors run it. Thus, there is a potential agency conflict. And also, most listed companies have thousands of shareholders, and it will be impossible for the directors to determine the individual goals of these shareholders. So, the generic shareholder value is assumed as the company's target. Added to this is the threat of takeover if a listed company's share price fails to perform. The situation in a private company is very different. The directors are often the owners; even if they are not, there is likely to be a strong link between the two. The directors can ask the shareholders directly what they want from the company. The answer may not be shareholder value because in many private companies, the chief objectives are financial security for the family shareholders and the creation of a business to pass down to future generations. Shareholders in private companies may be reluctant to take on any debt, despite it being a good idea, if it means that they could lose sleep over it. And as private companies cannot suffer the threat of a hostile takeover, there is no need for them to follow the prescribed strategy of gearing up a low-risk business. Alright, that's all from our team. Thank you for your attention, and we hope this material will be beneficial for all, and we apologize for any kind of mistakes. Here are our references for further reading. Don't forget to like, subscribe, and leave a comment down below. Goodbye everyone!